Well, hello everybody. I think it's probably good to just kind of get this out of the way, just to acknowledge how weird this is. We're in the event of we're in the middle of something very strange happening in our lives, and now I'm sitting in my house making videos on a document camera, talking to myself, instead of sitting in front of a room talking to all of you. And it's very strange. It's a lot quieter than our class. But I just want to give you an idea of how I see this going forward. We're going to continue with the curriculum, although probably a fair bit slower. You'll see we'll put out some assignments twice a week. You know, we don't do a ton of notes in this class. I'm going to start with some notes just to kind of get us started on the new unit. And then we move into kind of one of the larger projects, the home buying project. So maybe I'll give little tutorials along the way to help you with that. That one will probably take us a couple of weeks. But for today, we're just going to begin talking about mortgages. So what you're going to need is you can just use a normal piece of paper if you want to just take notes that way. But I have uploaded a blank copy of this. So if you have the capability of printing, I would print that out so you can follow along with me. And because this is a video, you can just pause, you can rewind if there's something you missed. I've already written some of the things in that I want to talk about because I find that I'm not very good at talking and writing at the same time. That way this video won't be like super long. The homework, the assignment for this week is going to be to do the practice problems that are in here. So there's two places where I'm going to go over an example. I'm going to go over the example pretty carefully. And then following those, there's a few practice problems. So I think there's like 5 or 6 things for you to work on. And I'll point those out when we get there. All right, so I'll just jump right into it. So it is, what is a mortgage? Okay, so mortgage is very similar to what we've already calculated when you did the car buying project. But a mortgage very specifically is a loan for property. And most people, when we're talking about mortgages, just think about mortgages as you buying a home. But it doesn't have to be a home. You could get a mortgage for buying kind of a plot of land, and then you can build your own home there. So mortgages are a big deal. These are typically very large because homes are very expensive. It's a home, if you get the opportunity to buy a home, and I hope you all do, it is likely the most expensive thing you will ever buy in your life. So it is a secure loan. And so this is something we've talked about before. I brought up this idea several times, the idea of why can you get a car loan for an interest rate of a few percent, but if you wanted to just go to the bank and borrow $10,000, the interest rate is actually very high. And it's the idea of it being a secure loan. So in this case, the loan is backed by the value of the property. So what that means is you can get a lower interest rate on a mortgage or a car because it's backed by the thing that you're buying with it. So if you don't pay your mortgage, the bank can still get some money because they can foreclose. They can take your house. If you don't pay your car payment, the bank can still make some money because they can repossess. They can take your car. If you don't pay your cash loan, the only thing they can really do is take you to court, and you might not have that money, so there's really no way for them to actually get it. Even if they take you to court, if you don't have the money, it's an annoying process for them. But this is why mortgage interest rates can actually be quite low. So the loan amount is just the amount that you have to borrow. So this is easily calculated. The loan amount is equal to how much you buy the home for, so it's the selling price, minus whatever down payment you have. Okay, so the down payment will vary. Similar to a car, the recommended down payment is 20%. When you look at how expensive homes are, you see 20% of a home is actually quite a lot. But we'll talk about this actually on the next page. So a couple of different things for mortgages, different types of mortgage. These are the two most common. So I'll take a second to talk about those, and we'll just kind of fly through the less common ones. So the fixed rate mortgage and adjustable rate mortgage are pretty kind of self-explanatory with the difference there. So with the fixed rate mortgage, the interest rate is the same forever. It is fixed. So it is the same for the entire loan. And typically, mortgages run for either 15 or 30 years. So you are paying this off for an exceptionally long time. An adjustable rate mortgage is one where the interest rate can change. Now, it doesn't just change every day. It can change every year. And now, this is usually where, if I was in a room with 25 of you, somebody usually asks, well, which one's better? And in most cases, when you're dealing with things financially, some things are better for some people, some things are better for others. I always lean towards thinking about fixed rate mortgage, just because when you buy a home, this will be the most expensive thing that you pay for in your life. And you don't want it to kind of randomly become more expensive. Okay, yes, the interest rate could go down, but if it goes up 1%, 2%, 3%, over the course of a few years, now your largest bill that you budgeted for when you bought it is now actually getting kind of even larger. So I personally have a fixed rate mortgage, but depending on what the actual numbers are, it could be better for you. Now the less common types here, these are kind of special types of adjustable rate mortgages. They can be kind of divided up. So, for instance, you could have a 10-1 adjustable rate mortgage. So it's kind of a blend of both of these. So the interest rate would be fixed for 10 years, and then it could possibly change every 1 year after that. Same thing with these. So the first number is how many years you have the fixed rate mortgage for, and then the second number is how often it can change afterwards. Okay, so that's kind of a less common variant on that. Something that you will probably never do with your own home, hopefully. Something called a balloon mortgage. Okay, so this is not amortized. Remember, we did the amortization schedule with the car loans. All that means is that you take all of the money, all of your payments with all of the interest, and it recalculates it, divides it out, so that all your payments are the same. Remember with the car buying project, you made those like bar graphs. All the bars were the same height. That's because it was amortized, but the way that bar was divided up between interest and principal changed. That's the way mortgages are done as well. So it's the same payment for all 15 years or 30 years. But for a balloon mortgage, what you do is you pay very, very small amounts of money for a few years, and then there's just a gigantic payment at the end. You would probably never do that. It's mostly used in kind of, less common situations, usually not by personal people. So one example is if you were a construction company, okay, if you need a loan to buy just the land, there's not really any collateral there for when you get the loan, so you probably can't get a very good interest rate. Okay, it's not secured yet because it's not really secured by the value of a home. It's just a plot of land. So it is secured to some respect, but not as much as if there's actual property there. So you can get a balloon mortgage for the land, spend a year or whatever building the home. And then once the home is built, you can refinance, get a new loan, and that new loan can be backed by the value of whatever home you built. Interest-only loan is pretty much the same idea. It's a loan where you only pay the interest, which means when you're done with that loan, you still owe everything. So it doesn't actually move you forward. Generally, probably a bad idea. Okay. The mortgage rate is just another word for just interest rate that we'll be using. Okay, so this is the rate of interest on the mortgage. And APR is the same thing from the car buying project. So that's the annual percentage rate. Okay. So the benefit of this is a single percentage that includes your actual costs. That represents your actual costs, including fees. Okay. So again, quick background why this exists. People used to just advertise low interest rates, but then there'd be fees to get the loan, and people would end up paying more money, and they were confused. So this is now a legal requirement, so you have kind of a more clear understanding of what you have to pay. Locking. So the interest rates you can get on a mortgage change kind of constantly, and that can be kind of stressful when you're looking to buy a home. So what you can do is you can lock in an interest rate. So if you see that you have an interest rate of 3.5%, you see that that's what the interest rate is. And you're afraid that, by the time I write the paperwork for this in a week, what if that goes up to 4%, right? You can lock it in. So you can basically lock in a interest rate for 30 days. So if you see that you can get an interest rate of 3.5%, you could lock it in with the company that's doing your mortgage. And then over the next 30 days, if the interest rate goes up, you still are allowed to get your mortgage at that 3.5%. If it goes down, you're not locked at 3.5%. You would just relock it when it's lower. So it's really just a protection for you. Okay, so there's no reason not to do that. Term is just the length of the mortgage. I don't think there's any actual requirement for what this has to be written as, but it's typically 15 or 30 years. Okay, so a very long time. And the last thing here, closing costs. So these are fees that you pay at closing. Closing is when you actually go with the lawyers and the people who are selling the home, and you just sign all the paperwork. There's like 1,000 sheets of paper that you have to initial and sign. So this is typically about, in Massachusetts, it's about $3,800. Okay. And that includes several things. It includes like a title fee. There's fees for getting the title of the home rewritten in your name, or at least to your mortgage company. There's lender fees, and a lot of this money is usually used to start an escrow account for you. And we will talk a lot more about escrow in a future lesson. So we'll just leave that there. Escrow is essentially like a side bank account to help you pay for like insurance and property taxes and stuff like that. But we don't need to worry about that now. Okay. So when you are shopping around, okay, one thing that they must provide for you is a good faith estimate. And so what this is another legally binding thing. So within 3 days, they have to give you kind of this itemized list of fees associated with the loan. So there's a very high degree of transparency that's required when you're getting a home loan. Okay, so that's called the good faith estimate. And you probably won't have to ask for this because it is a law. So they should be very upfront with this when you're looking for a home. Okay. Now, let's actually do some calculations. So you want to make sure, if you don't have a calculator, pause, go get a calculator, come on back. So buying a first home. The 20% down payment is usually most easily paid for by you selling your first home. So you sell a home at the same time that you're buying a home. Hopefully you're making a little money on your first home, you can use that as a down payment on the second one. But what do you do with your first home? You need 20% down payment. So the average price of a house in our beautiful state of Massachusetts is $340,000. Okay, so that means that your expected down payment is 20% of that. That's going to be $68,000. Okay, so for the bank to consider you a quote unquote good person to lend money to, you need to have almost $70,000 of cash for a home like this. Now, this is the average Massachusetts home price. Buying your first home is probably not going to be this expensive. I bought my first home. I bought my home for about $189,000. So it's still a lot of money, just not quite this much. So $68,000. Who has that much cash? Well, I certainly didn't. So I paid about 3% down for my home, for my $180,000 home, not 20. And so that provides a little bit of a hesitancy to the banks, because the way you demonstrate that you can pay the loan is by having a lot of money. The way you demonstrate to them that you don't have a lot of money is when you're only putting 3% down, like I did. So that's the situation a lot of people are in. And what that leads to is something called PMI, which is private mortgage insurance. So if your payment's less than 20%, you'll have to pay into PMI. Okay. Now, why do you pay into PMI? So because you haven't had a large down payment, right? You haven't demonstrated that you are a safe investment. And banks hate risk. Okay, so it's almost like it's almost like you're not totally trusted to be able to pay for this home. Okay, so this makes banks nervous. You will default. So that's where you start missing your mortgage payments. Okay, and then they would have to then repossess your home. They would foreclose on your home. That's all entirely time consuming. And it's very expensive to do. So they actually don't want to take your home. So what does PMI do? PMI is insurance against you not being able to pay your loan. So what would happen is, if you end up kind of defaulting, PMI pays out the lender. So they make money from you not being able to pay your loan. It's usually not enough to recoup all of their losses, because they will end up losing money on you probably. But it's just kind of a strange situation, because you buy health insurance to stop you from losing money from getting sick, and you buy car insurance so that you don't lose money in a car accident. But here, you are buying this insurance essentially on behalf of the lender. So it's not really how insurance typically works. You would think that they would have to be buying their own insurance policy on you, but they're essentially just making you pay for that insurance policy. So, sorry. PMI rates, they vary. They're usually about 0.5%. They could go as high as 1%. For our calculations, we're always going to kind of use the same number for consistency. We're going to use 0.44% of the loan amount, of the annual loan. Okay. And how long do you have to pay PMI? Well, why are you paying PMI in the first place? You're paying PMI because you did not put a 20% down payment. So you will pay PMI until you have paid 20% of the value of the home. So basically, if you don't have 20% as the down payment, you'll have to pay until you reach that 20%. And this will automatically end at 22%. Now, why are these numbers different? It used to be that if you were paying PMI, you would have to kind of keep track of it yourself. And then once you get to 20%, you call the bank, you say, hey, I'm not paying this anymore. But nobody did that because everybody forgot, because this takes many years. And then people just kept paying PMI for 30 years. And banks just collected all that money, because at that point, PMI is not really doing anything. So they added this into law for it to automatically end at 22%. Now, why is the law not at 20%? You only need to pay until 20. Why doesn't it just end at 20? Essentially, this probably came from lobbying of banks because this law eliminated a whole bunch of years of people paying PMI when they didn't have to. So capping it at 22% gives them an extra 2% of the loan of wiggle room where you can still screw up and keep paying. So, sorry. So pay attention to it. Loan to value ratio. A ratio is just a comparison of two numbers. So this is just the mortgage amount owed compared to the value of the home. Okay? So the amount that you owe compared to the value of the home, right? If you did a 20% down payment, then the amount that you owe compared to the value of the home would be 80%. So just as a quick example, if you had a $60,000 balance, there's only one L in balance, don't mind that. Balance on a $100,000 loan. Okay, then the loan to value ratio would be that $60,000 compared to the $100,000, and that is 60%. Okay, so because that is less than 80%, you should not have to be paying PMI. Okay, all right. So we'll do an example here for PMI. We do a couple examples, and then this is your homework. Okay. So John is buying a $260,000 home, and he's able to put down a 3% down payment. John will have to pay PMI, and the PMI interest rate is 0.44%. What is his amount to be financed, and what is the monthly cost of PMI? Okay. So we'll do these kind of separately. So the amount to be financed. Okay. So the amount to be financed is, let's see, if I have a 3% down payment, that means I'm going to pay 97% of the loan. Okay. So I have a $260,000 home. I'm paying, okay, or I'm borrowing, 97% of it. So grab our calculators here. This ends up being $252,200. Okay. So that's our first part. And I need that to talk about my PMI, because the PMI for a year, okay, a year's worth of PMI is that percentage of your loan. So the 0.44% as a decimal, remember, even though this is already decimal, to make it into decimal form, I still have to divide it by 100. So this is going to have 2 zeros and then the 4. So 0.0044 of the loan amount. This is $252,200. So that's how much PMI I'm going to have to pay over the course of an entire year. So if I want my monthly PMI, I have to divide that by how many months are in a year, which is 12. Okay, and to calculate that out, this comes out to be $92.47 per month. So the fact that you didn't have enough money for your down payment, or you didn't put 20% down, you have to pay essentially an extra $90 every month in this insurance. So it's not backbreaking, but you'd rather go out to dinner with that money. All right. So there's a few questions here. I want you to do these for homework. So if you're not going to copy, if you didn't print this, you can at least go online to the version that I gave you to copy, and you can just work on it from your computer. So there's 3 questions here, and there's a few more questions on the back. Okay. So the last thing I want to do before we do all these calculations by hand, which is what we're going to be doing probably next time, is looking at kind of what people actually probably do most often, because people aren't usually sitting in their office doing algebra. they use something called a mortgage payment table. So here's an example mortgage payment table. Let's see if I probably need to zoom in here. Okay. So in this table, you have an interest rate, and then you have different amounts of money for a 15-year term and a 30-year term. So you have a kind of a ratio here for the monthly payments and a ratio for the total amount that you have to pay. And these are kind of ratios based on every $1,000 of loan. Okay. So the way this works, I'll do an example and then I'll let you try some of these. Okay. My example actually uses the one typo in this whole thing. So if you look down here, if you look at the 5.375%, all the way at the end, if you notice this weird jump, it goes from over 1,900 down to 1,000 and then back up to 2,000. That's because there's a typo. This should be 2015. Okay. So we're going to use that one. All right. So what is the monthly amount and the total cost of a $150,000 loan? So for monthly, okay, this whole table is based on how many thousands of dollars the loan is. So 150,000 is 150 of those, obviously. Now, it might not always be that clean. So what you just want to do is just take that loan amount and divide it by 1,000. So in this case, that's going to be 150. And this is times whatever this ratio is. So I want to find in the table a 30-year mortgage at 5.625%. Okay, so I want to find 5.625%. Where are we there? 5.625% is right here. So if I read over, we want the first column here is monthly for a 15-year loan. Then we have monthly, or the total amount for a 15-year loan. And then over here, we have 5.76. Okay. So that's the monthly payment for the 30-year loan. So we have 5.76. So that's what I want to use in here. All right. And when you multiply these things out, you get $864. All right. So that is the monthly mortgage for this $150,000 home. And then for the total cost, okay, again, we want the 150,000 divided by 1,000. So there's 150 of these. And then we need the ratio for the total cost. Okay, so it's the same place, 5.65%. This is the ratio for monthly. So the ratio for total is 2,074.36. Okay, so you just grab your calculator, 2,074.36 times that 150,000. Okay, and this ends up being, okay, you're going to think this might be a typo, but it's 311,154. Okay, so at that interest rate, you borrowing $150,000 over the course of 30 years, you do end up paying back actually more than double what you borrowed, and that is kind of the downside of these exponentials, of this compounding interest. Okay, and that's going to be common. You'll probably see a lot of this, that you're essentially paying double. Okay, so this video is already very long. I'm very sorry. So there are just 3 more examples that go along with this. Okay, 3 more practice questions. So your homework is going to be to finish those practice questions in there. Email me if you have any questions, clearly. Hopefully I'll see you on Friday for some office hours. Hope everybody's staying healthy and doing okay. Take care.